Happy Friday, friends. It's Shayan with Integrity Home Mortgage back with your rates rundown for November 7th, 2025. So 10-year Treasury yields and mortgage rates are both about a basis point higher. It's a very little change on a week over week basis, but that doesn't mean that nothing happened. Conflicting economic data took turns showing markets hawkish and dovish signals. Hawkish meaning favoring higher rates or more restrictive policy. Dovish, of course, meaning the opposite, favoring lower rates or more expansionary policy. I'm not exactly sure what the deal is with the whole bird motif. I suspect it's probably because economists note the Fed is often just winging it. Um, we remain stuck in the data desert, but in the absence of good data, markets continue to be ready, willing, and able to react to whatever information becomes available. This week, that was in the form of employment data from payroll processing company ADP and data on layoffs from staffing firm Challenger Gray and Christmas. A hawkish signal on Wednesday when ADP reported that we added 45,000 new jobs, which outpaced the expectation of 25,000 and was a significant improvement over last month, where they estimated a net loss of about 30,000 jobs. Markets predictably sold off in response, and interest rates briefly touched a 1 month high. Dovish signal on Thursday when Challenger reported over 153,000 corporate layoffs in October. That's the worst October we've seen in 22 years. And again, predictably, markets promptly fell back in line, rallying back to roughly where we started the week. Both are poor substitutes for BLS data, so they should be taken with a grain of salt, but they're not right now because that's all the data we got. Uh, Over time, these data points tend to offer a source of confirmation around, directionality and magnitude of changes in labor markets, but on a month-to-month basis, correlation tends to be pretty poor. Other notable pieces of information this week on the hawkish side: ISM Services PMI rose unexpectedly, unexpectedly, which signaled some inflationary pressures outside of just goods. We all know that the Fed has been looking past tariff impacts on the prices of goods recently. Prices for services, however, are far less impacted by tariffs and therefore are harder to look past as temporary one time impacts when it comes to Fed decision making. On the dovish side, consumer sentiment hit its lowest level in 3 years, confirming consumers are worried about the economy and perhaps feeling the impacts of the shutdown. Speaking of shutdowns, we have officially broken a record that nobody wanted to break. The longest shutdown in history, now in its 38th day, between flight cuts being announced at dozens of major airports just 3 weeks before we start thinking about yet another bird, the turkey, and Tuesday's election results, it seems that Congress has finally found just a little bit of motivation to start working on a path towards resolution. Behind the scenes, we are hearing of conversations being had among respective party members, and leadership has been soft launching some trial balloons on potential areas of compromise, but it remains unclear exactly where the middle ground will emerge. It doesn't sound like much, but this is the most movement we've had some time, so I'm choosing to be optimistic for the time being. The reopening of government will be good news, and not just for government employees, contractors, and SNAP recipients, but it doesn't come without some risks. Markets are keenly aware that the end of the shutdown would mean an immediate release of all sorts of pent up jobs and inflation data, which likely means a significant uptick in volatility in rates markets. The BLS historically prioritizes the release of delayed data at the end of a shutdown, so expect several weeks worth of key data to flood the wire within days of resolution. At current levels, 10-year Treasury yields, which are what are most correlated with mortgage rates, reflect a dovish consensus, meaning that prices are reflective of markets' belief that the Fed will continue to cut rates because labor markets are softening, and that poses a higher risk to the economy than mildly elevated inflation. It's pretty easy to predict what will happen if that glut of data all points to either a confirmation or a rejection of that consensus. Weaker data equals lower rates, stronger data equals higher rates. Fairly simple. The problem with recent data is that, in this week included, is that it doesn't seem to want to all point in one direction. The fact is, both issues are very much real. Job markets have weakened, and inflation is running hot. So it's not just about which one of these things gets solved first. It's also about figuring out at what point does the calculus change around which poses the greater risk to the overall economy, because the strategy to solve one is to do the opposite of what solves the other. So my bottom line this week is twofold. Number one, rates are stuck in a very tight range, and that will continue to hang and that will continue to hang around these levels until we get new information significant enough to shake up the current assumption of around one more Fed cut before it's all said and done. And the end to the shutdown will be an overall positive for the economy and for the quality of life for millions of Americans, but it will likely be accompanied by significant near term volatility. That's it for this week. Hope you guys have a great weekend, and we will see you next time.